Welcome to Iron Financial. This is the only place that stress tests the market's biggest names to find out if they're built on solid rock or just shifting sand. I'm your lead analyst, and with me is our market skeptic. Today, we are putting AutoNation directly under the microscope. Their latest earnings report is a complete paradox. Revenue is down, but profits are up. We're here to forge through the noise and tell you if this is a sign of real strength or a warning of a major crack in the foundation. Let's get to work.
So here it is. This is the puzzle at the very heart of this report. In Q4, AutoNation's revenue actually shrank by 4%. I mean, that's a huge red flag in this market, especially with everyone whispering about a consumer slowdown. But, and you got to pay attention here, their adjusted earnings per share, the bottom line profit, it actually went up. So the big question is, what is really going on here? Is this some kind of masterclass in efficiency and discipline management? Or is it just clever financial engineering designed to mask a really deep core weakness? We're going to drill down layer by layer and find out for you if this company's foundation is truly solid.
All right, here's our game plan for today. First up, we're going to lay out these conflicting signals that are coming from the headline numbers. Then, our lead analyst is going to build the bull case, what we're calling Fortress AN. After that, well, I'm going to do my job and stress test that fortress for any foundational cracks. Then we'll go under the hood and really look at the different business segments. We'll examine how they're allocating their capital, and finally, we'll deliver the Iron Financial verdict. Look, this is going to be a deep, structured investigation, not just some surface-level glance.
Okay, let's get right into it. Section 1, the conflicting signals. We're calling this the headline paradox. And honestly, from a 30,000-foot view, these numbers are pulling into completely different directions, which makes this a fascinating case study on how a company tries to navigate a really tricky economic environment. So let's break down the specific numbers that are causing all this confusion and debate out on the street.
This slide really tells the tale of two different timelines. If you look at the full year for 2025, it looks like a picture of perfect health. Revenue is up 3% to nearly $28 billion, and adjusted EPS is up a massive 16%. That's some seriously strong performance, and it suggests a really solid year. But then you look at the most recent quarter, Q4. The trend just completely reverses. Revenue is down 4%, and yeah, adjusted EPS is still positive, but it's only up 2%. The momentum has clearly slowed down. So this is the paradox we're talking about. Is the full-year number the real story of resilience, or is Q4 a huge warning sign of structural problems to come?
All right, now let's build the bull case. We're calling it Fortress AN. Because the bull argument is that this company is a financial stronghold. It's able to withstand these market headwinds and generate enormous value, regardless of a little dip in sales. Now, the first and most important pillar of this fortress, it's its ability to generate cold, hard cash. Forget about the accounting profits for a second. Let's talk about cash flow. That's the lifeblood of any business.
$1.05 billion. Just let that number sink in for a moment. That is AutoNation's adjusted free cash flow for 2025. This isn't revenue, it's not some paper profit. This is the surplus cash left over after all the expenses and all the investments are paid. It is a fire hose of cash that they can use to reinvest, pay down their debt, buy back stock, or go out and acquire competitors. In an economy where capital is getting more and more expensive, a company that can internally generate over $1 billion in free cash is an absolute force to be reckoned with. This right here, this is the bedrock of the entire bull case.
Okay, so that billion-dollar number is impressive, for sure. But this slide shows you the quality of that cash flow. For every single dollar of adjusted net income they reported, they generated $1.25 in actual free cash. That's a 125% conversion rate. Most companies out there, they struggle just to hit 100%. This shows you that AutoNation's earnings aren't some accounting fantasy. They are incredibly efficient at turning reported profits into tangible cash in the bank. This is the sign of a well-oiled, cash-generating machine that's built on just incredibly disciplined management.
So what do you do with all that cash? Well, you reinforce your fortress. AutoNation spent $785 million buying back its own shares in 2025. Think about what that means. This is management making a massive $750 million bet that their own stock is undervalued. This action reduced the total number of outstanding shares by about 10%. So for every shareholder that's left, their piece of the pie just got that much bigger, and it mechanically boosts the earnings per share. It is a powerful signal of confidence coming from the inside.
So, to sum it all up, the bull thesis really rests on these 5 pillars. First, the massive and highly efficient cash generation that we just saw. Second, aggressive shareholder returns through buybacks that signal confidence and reward investors. Third, and we're going to dig into this in a minute, they're hitting record profitability in their high-margin segments. Fourth, they're making smart, strategic acquisitions that add quality revenue to the top line. And fifth, they're building out a growing in-house finance arm, which is a scalable profit center. Together, all of these things create the image of an absolutely impenetrable financial fortress.
A fortress is a great story, sure, and a fire hose of cash sounds fantastic, but a fortress is only as strong as the ground it's built on. And that fire hose, it can't hide the fact that the core business of an auto dealer is, believe it or not, selling cars. And when you look at that core business, you start to see some real cracks in the foundation. It's my job to stress test this structure, and I'm seeing some pretty serious weaknesses that cash flow alone just can't fix.
Let's just ignore the adjustments for a moment and look at the hard numbers for the most recent quarter. Revenue is down 4%, but look deeper. Operating income is down 8%, which means their core profitability is declining even faster than the revenue is. Now, the same-store numbers, which strip out the acquisitions, they're even more concerning. Same-store revenue is down 5%. And right here, this is the real alarm bell. Same-store new vehicle sales fell off a cliff. They're down 10%. Used vehicles, down 5%. You can talk about a fortress all you want, but if fewer people are coming through your doors to buy your primary product, you have a fundamental demand problem. And this isn't just a company issue, it reflects a broader market where high interest rates are really starting to bite consumers.
And this isn't just about one tough quarter. It's about their long-term strategy. This is a direct quote from the CEO, Mike Manley, from the previous quarter's call. He called EV profit margins absolutely terrible. And this came after the entire industry, AutoNation included, spent years pushing the EV narrative. I mean, they invested heavily in inventory, charging infrastructure, and marketing. Now they're doing a hard pivot away because the economics just don't work. And look, while adapting is smart, this kind of strategic whiplash makes you wonder if they have a clear vision for the future or if they're just reacting to trends. This uncertainty, that's a crack in the leadership pillar.
So the bear case is pretty simple, and it's grounded in operational reality. You've got declining top-line revenue. You have a significant drop in same-store unit sales, which indicates core business weakness. You have high leverage. With a debt-to-equity ratio of 1.93, that means they have nearly twice as much debt as they do equity. Then you add in the strategic uncertainty from that whole EV pivot, and you have to ask the critical question, is this profit growth real and sustainable, or is it just financial engineering? Are those massive share buybacks just using cash to put a new coat of paint on a crumbling foundation?
The skeptic makes some valid points. Unit sales are weak. I mean, nobody can deny that. But focusing only on unit sales is like judging a master blacksmith by the amount of coal he burns instead of the quality of the steel he forges. You're completely missing the point. To understand AutoNation's real strength, you have to look under the hood at the different business segments. It's not about how many cars they sell, it's about how much money they make on everything that happens around that sale. That's where the real profit is forged.
Okay, so first, the baseline. This chart shows where the company's nearly $28 billion in revenue actually comes from. And as you'd probably expect, vehicle sales are the lion's share, making up over 77% of all revenue. The other segments, parts and service, which we call after-sales, and finance and insurance, they almost look like an afterthought, making up less than a quarter of the total revenue. Now, if you stop here, the bear case looks airtight. But this is only half the story.
Now this slide is the core of the bull argument. This changes everything. This isn't revenue. This is gross profit contribution. Just look at this. Those two small revenue segments, parts and service and F&I, which made up less than 23% of revenue, they generate a staggering 47% of the company's gross profit. Let me repeat that. Nearly half of the company's profit comes from less than a quarter of its sales. This is the real engine of AutoNation. Selling cars gets the customers in the door. The real high-margin business is financing those cars and then servicing them for years to come. That is the business model.
And here's the crucial point. While unit sales were declining, the profitability of the most important parts of the business was hitting all-time highs. They reported record after-sales gross profit for the year and record profit per unit from their customer financial services. This demonstrates a successful strategic pivot. They are consciously focusing on higher-margin, more resilient business lines. They're becoming less of a simple car dealer and more of a full-service automotive platform. They are sacrificing low-quality revenue from terrible-margin EVs to maximize high-quality profit from services. That's not weakness, that's smart, disciplined management. Okay, you know what? I will concede the margin point.
That profit mix is impressive. I really can't deny it. But that just brings us back to the fire hose of cash. We know they have it, and we know where it's coming from. But the question then becomes, how are they deploying it? A fortress with a massive treasury is great, but if the king is just throwing gold coins from the walls, it doesn't really make the kingdom any stronger. So we need to look at their capital allocation strategy. Is it smart, long-term investment designed to reinforce the structure, or are they just buying time and propping up the share price?
The strategy is clear, it's disciplined, and it's multi-pronged. Here's exactly how they're putting that $1 billion in free cash flow to work. Step 1, $785 million in buybacks, a massive vote of confidence that we've already discussed. Step 2, they're playing offense. They completed acquisitions that add over $650 million in annualized revenue, and they were smart about it. As you can see, buying up premium, high-demand brands like Toyota, Audi, and Mercedes-Benz in key markets. Step 3, they're investing in organic growth by scaling their own finance arm, which now has a $2.2 billion loan portfolio. And Step 4, maintaining a rock-solid liquidity position of $1.8 billion. This is not just buying time, it's a balanced attack of shareholder returns, strategic expansion, and internal investment.
And let me directly address the skeptic's concern about the debt. That 1.93 debt-to-equity ratio, it can look scary in a vacuum. But in this industry, you have to look at the numbers the banks look at. This is the covenant leverage ratio. It's a specific calculation that the creditors use to determine financial health. Now, the maximum they're allowed is 3.75x. Their actual ratio is only 2.44x. They are not even close to tripping their debt covenants. They have plenty of breathing room. The fortress walls are thick, and believe me, the lenders are not worried. The debt is manageable, and it's well within the limits of what this cash-generating machine can support.
So we've seen both sides of the coin. The bull case of a financial fortress built on a foundation of cash flow and high-margin services. And we have stress-tested that fortress, and we've found some very real cracks in the foundation of its core sales business. Now it's time to step back, weigh all the evidence we've laid out, and forge the final iron financial verdict. Is AutoNation an opportunity, or is it a trap?
This is where the hammer meets the anvil. On the bull side, the evidence for a financial fortress is really compelling. Dominant free cash flow, aggressive shareholder returns, and a successful expansion into high-margin segments. From a purely financial perspective, the structure is undeniably strong. But on the bear side, you simply cannot ignore the cracks in the operational metrics. That 4% decline in Q4 revenue and that shocking 10% drop in same-store new vehicle sales, those are not trivial. The core business is shrinking. The debt, while it's manageable by covenant standards, is still a significant load to carry, and their success is still heavily dependent on the car manufacturers that they partner with.
After weighing all the evidence, the iron financial verdict is this. AutoNation is a durable, powerful, cash-generating machine that is masking significant top-line weakness through masterful financial management and a strategic shift to higher-margin services. The fortress, the cash flow, the shareholder returns, they are all real. This isn't a company on the verge of collapse. But, and this is critical, it is not a growth story right now. The engine is running beautifully, but the car is rolling backward down a hill. Until they can reverse the decline in vehicle sales, this is a story of incredible efficiency and shareholder value, but it is not one of expansion.
And so we leave you with this final, crucial question. Our analysis shows the company is financially sound, but it's operationally challenged. So the question isn't just, is AutoNation a good company? The answer is, financially, yes. The real question you have to ask is about valuation. Is the current stock price justified for a low-growth, high-cash-flow business? You have to decide if you're paying for a growth stock, which this is not, or if you're buying a mature cash cow at a reasonable price. That's the heavy lifting you have to do for your own portfolio. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.